Good afternoon, everyone, and thank you for joining us today for this Hartford Business Journal and New Haven Biz webinar. My name is Greg Bordenaro, and I'm the editor of the Hartford Business Journal, and I'll be your host and moderator for this virtual event, which will focus on helping business decision makers better understand the loan forgiveness rules and regulations under the federal government's Paycheck Protection Program, or PPP. As many of you know, Congress has approved $660 billion in funding for PPP, which provides low interest and potentially forgivable loans to small businesses with fewer than 500 employees to keep workers on their payroll. The first round of funding was approved in late April and was used up in a few weeks. The second round of funding remains ongoing. Through May 23rd, the SBA approved more than 4.4 million PPP loans totaling more than $511 billion. About $138 billion in PPP funds remain available as of May 23rd. So far in Connecticut, the SBA has approved nearly 56,000 PPP loans totaling $6.6 billion. On May 15th, the SBA released the PPP loan forgiveness application, and our aim today is to get you up to speed on the rules and regulations related to forgiveness, as well as other recent developments with the program. I'd like to start off today by thanking our sponsors who helped make this virtual event possible. Thank you to our platinum sponsor, Whittlesey. Founded in Hartford in 1961, Whittlesey is one of the largest regional CPA and consulting firms in New England. With offices in Connecticut and Massachusetts, the firm provides a comprehensive array of advisory, assurance, tax, and technology services to a broad range of businesses, organizations, and individuals. And thank you to our event partner, law firm Robinson & Cole. We've got representatives from our sponsors as part of our panel today, who I'll introduce in just a moment. We also have another special guest joining us, Mark Hayward, who is the SBA's District Director in Rhode Island and interim District Director for SBA's Connecticut office. Our other participants today include Drew Andrews, Managing Partner and CEO of Whittlesey. Drew is responsible for developing and executing firm strategy, and under his leadership, the firm has experienced significant growth, doubling revenue and expanding geographically, with 3 offices across Connecticut and Massachusetts. We also have Taylor Shea, a partner at law firm Robinson & Cole. Taylor represents privately and publicly held companies in corporate and transactional law, including commercial finance transactions, private equity and venture capital transactions, mergers and acquisitions, and general corporate and commercial matters. Our webinar today will run for about 45 minutes. Many of our attendees have sent us questions in advance that we'll be asking toward the end of the program. Listeners, feel free to also submit questions via the Q&A button on your screen as the conversation is happening. We're going to start off the program today by talking to Mark Hayward from the SBA. Good afternoon, Mark.
Good afternoon. Thank you for having me today.
Thanks for joining us. First of all, can you tell us what's the status of the second round of PPP funding?
Yeah, second round of PPP funding actually is going really well. There's still approximately $110 billion that is left in round 2 and is available for small businesses to access.
And, a lot of people were predicting that money for the second round of PPP would go quickly and that we might even need a third round. Yeah, a good chunk of money still remains available. Why did interest seem to diminish for the program during round 2?
I actually don't think that the interest diminished whatsoever. What happened is in round 1, the average loan size of PPP was approximately $140,000. Here in the second round of PPP, we're seeing the actual loan size to be significantly less. Actually, I believe the last time I looked, it was about $74,000. Per loans, which is significantly less. And then in saying that, where people are saying, well, it seems like the loan fund has grown. As you can recall, there was a period there where the Treasury put out forgiveness rules of individuals who took the PPP that didn't think that they should have taken the PPP, they could return it. A lot of those was fairly large loans, and what's happened is those were reconciled and the money went actually back into the pot to be lent out to other small businesses.
Sure. So I guess besides the larger companies returning their loans, what other reasons were there for the loan size being smaller in the second round of PPP?
No, I just think that the moms and the pops, the really small businesses throughout the state of Connecticut and actually throughout the U.S., because that's a we saw that basically across the plane, where the loan size was significantly less, and that the people who were being served were also included with sole proprietors as well as 1099s. And if you can remember, the 1099s and sole props had to wait 10 days before they could come into the system in the first round. So a lot of those individuals, which are single businesses with just one employee, had to wait. So I think that's probably the reason for there is a significant increase in the actual number of small businesses served in the second round than there was in the first round. But again, the loan sizes are significantly less.
Sure. Can companies still apply right now? And what's your take on when this, the rest of the funds might run out?
Well, no loan can be made after June 30th, the way the statute reads right now. All loans have to be on the books and have to be dispersed prior to June 30. So that certainly gives us a finite number and a finite date. But no, we're working with businesses right now, trying to determine as to whether or not it is in their best interest to move forward with a PPP.
Sure. And how would you characterize bank interest? I know it was really strong in the beginning during the first round. Has that carried into the second round? And are all the banks that participated at the start still doing it?
I don't think there's been any diminution of interest by any of the banks across the state of Connecticut or across the U.S. I think there are. This is an opportunity for them to increase their portfolios, to get new customers, and I think for those small businesses that don't have a banking relationship, this really is probably a good opportunity for them to establish a good, sound banking relationship. And I have always, in my 30 some odd years of doing this, I always told people it's important to have a good banker, a good lawyer, and a good accountant, and to stay close to them. Don't surprise them.
I'm sure other panelists like to hear that.
Yeah.
A lot of companies have complained about the rules requiring 75% of the PPP funds to be used on payroll, and also the rule that requires companies to use the money within 8 weeks of receiving it. There was also that Inspector General's report that said Congress sort of didn't mandate those rules. So I was wondering, can you address those concerns among small businesses and sort of the rationale behind those rules?
Yeah, no, and I'll tell you why. The one thing that we have learned, and I have learned in my 40-year career in the federal government, is I carry out the policy, don't make the policy. So whatever the policy is, it is made by those individuals in Washington. And I was also a policymaker at one point in time in Washington. That's what it is. What we try to do in the field is to provide as much direction and resources to make sure that those individuals are living within those parameters. I have heard, as everybody else has, is there are concerns about the 75-25 and the time limits. And I've had significant discussions with members of the congressional delegation in the state of Connecticut, actually pretty frequently, including just a few hours ago. And they're well aware of it, and policy will be made at another level, certainly above my pay grade.
Sure. What have the policymakers said to you? I know there's a couple bills in Congress that might change some of these rules, particularly the two that I just mentioned. What's your thoughts about that? And does the SBA and Treasury have the authority to tweak the rules as well?
I can't answer whether or not SBA and Treasury have the authority. That really is for our legal experts in Washington. But what I can say is that it is without hesitation that particularly the hospitality industry has made it abundantly clear to both all of the members of Congress about the concerns that they have about the shortness of the period of time to be able to expend those dollars within that 8-week period. In some instances, there is a little bit of a disconnect because people will literally trying to read into it. Okay, I was approved on May 1st. I got my money on May 14th or May 10th, and I have to begin spending on May 10th. If it fell in the middle of a pay period, and you pay every 2 weeks, then it says basically you could wait to begin that process. So there was a little bit of leeway there, and I realized that a lot of people have been asking those questions. But I spoke with Senator Blumenthal today and his staff as well, and we did have a brief chat about there is a bill in the House which is a little bit different than the bill in the Senate that was done by Senator Rubio, Senator Collins, Senator Cardin, and Senator Shaheen, who were the original people who wrote the PPP to begin with. And they asked about how businesses in Connecticut was basically trying to maneuver through all of those aspects. And I gave them my best information that I have based upon what I've, my discussions with small businesses. We in the district office talk to anywhere between 100 and 200. I talk between 100 and 200 businesses a day. I know the staff has a tremendous amount of calls and people they're responding to. But remember, we're not only responding on the PPP side, we're responding on the EIDL side as well.
Thank you for that. The SBA released guidance a week or two ago explaining which firms will and will not be audited. Can you discuss that and what the rules say?
Well, I think generally it said that if you had received over $2 million, more likely than not, you would be audited. But it also talked about that audits for those individuals less than $2 million would be based upon certain criteria. That's really within the Office of Credit Risk Management to make those determinations. And those of us in the field, I mean, we're just here to help support them, make sure that everything has been done in compliance with what the law is. So I'm not really sure. And I tell people all the time, as long as you've taken it out, you've done your calculations correct, that you have looked at the overall prospects of how you're going to bring your people back onto the payroll, paying your people over the 8-week period, spending the 25% on other ancillary costs, business costs, including utilities and leases and other things, that I don't see that there would be a huge issue about forgiveness. And I continue to say that. I mean, there was an additional clarification today that said, or yesterday that said, that companies could also pay bonuses to employees provided that they did not exceed the $100,000 per year stipulation. And yes, that's a new clarification, but I think people generally understand what the requirements are.
Besides the loan forgiveness guidance, what other important rules and regulations have come out in recent weeks that businesses should be aware of?
Well, they come out every day. And I would like to say that I have a crystal ball to see what Treasury is going to put up online, but unfortunately I don't. And I get the information when everybody else does. When the new regulations or interim final rules come up, or frequently asked questions, we get the same thing that everybody else does, and we go online and we clearly we have meetings and discussions about how we're going to proceed with it, but basically we're finding out when everybody else is.
Last question for you, Mark, for this round. How big of a challenge has it been to sort of roll out and oversee the program for the SBA?
That's a great question, because it's really, it's more the volume for us than anything else. We're trying to be, and you're just specifically talking about PPP. We have very small offices. I mean, and the office is basically trying to answer questions on PPP, what we see as the interpretation of the rules. How do we help banks? And we get calls every single day saying, I don't know what to do. I don't have, nobody has funded my PPP. Can you go in and we can go into the system on PPPs? I can see that there is a loan there. I can see that the bank has not dispersed it, and we can intercede and say, okay, what's the issue here? Which we have on many times. Or if there are two loans there and one has to be canceled and the other has to be dispersed, we can help in that too. But I think, the challenge is the fact that we're dealing with both what we know and what we can see from the PPP and what we can't see from the EIDL. And we're getting questions on both sides. Because remember, a lot of the individuals who also, PPP is for immediate need. That is the Paycheck Protection Program to make sure that people come back onto the payroll, that they're paid over an 8-week period. But the EIDL loan is for looking forward for working capital over the next 12 months. And we're getting questions on both sides. And the sheer volume has just been, it's been considerable, to say the least. but we're trying to handle all of that. And I think, to be very candid with you, I think the SBA employees in Connecticut have done an outstanding job. We have, as you said, 56,000 loans. I looked this morning on the idle side, and there were 6,000 loans, 6,300 loans approved for $591 million. So, I mean, there's a lot happening. It's not just PPP that we're working with. And on the other side of that, and I'll just to wrap up, we're also working with businesses who are on the cusp. People who are saying, I don't know what to do. How do I, basically giving them advice to try to get through these very difficult times. And we're also talking to people who are saying, listen, do I just throw it in and file for bankruptcy and try to move on from there? So, I mean, we're doing advice and counseling as well as doing everything else.
Thanks, Mark. We'll get back to you later in the Q&A session. Next, Drew Andrews and Taylor Shea will present an overview of the loan forgiveness rules and regulations that are currently available. Just a reminder, if you have questions that you want Drew, Taylor, or Mark to answer, please submit them via the Q&A button on your screen. We'll get to them in the final Q&A portion of today's program. Drew and Taylor, the floor is yours.
Thank you, Greg. It's Drew here. So I'll go over the process and documentation that's required. To receive the loan forgiveness, a borrower needs to complete and submit the loan forgiveness application, which was issued, I think, last week, and submit that to the lender that they received the loan from. And the lender will review and make a decision regarding forgiveness within 60 days of receipt of that. And the lender then will send it to the SBA for approval, and the SBA has 90 days to either agree or decide to review the application and grant the forgiveness. So if a portion of the loan is not forgiven, the borrower has 2 years to repay the loan. The documentation required is kind of broken up into two parts: payroll and non-payroll. Under payroll, what the borrower will need is bank account statements or third-party payroll provider reports that would document the amount of cash compensation paid. And they'd also need payroll tax filings to the IRS, typically a 941, and state quarterly unemployment insurance tax filings. And they'd also need payment receipts, canceled checks, or account statements documenting their contributions to health insurance and retirement plans. For non-payroll, there's probably 3 categories of non-payroll. Under business mortgage interest payments, they would need a copy of the lender amortization schedule and receipts or canceled checks verifying the payments during the covered period, or lender account statements from February 20 in the months of the covered period through 1 month after the end of the covered period that would verify the interest amounts. And under business rent or lease payments, they need a copy of the current lease agreement and receipts or canceled checks verifying the eligible payments during the covered period, and the lesser account statements from February 2020 and from the covered period through 1 month after the end of the covered period. For utility payments, they need copies of invoices and those paid during the covered period, and receipts, canceled checks, or account statements verifying those payments. That's the basic of what they would need for the process and the documentation. Under the forgiveness reduction and the FTE calculation. For the FTEs, if you reduce your FTEs during the covered period, your loan forgiveness would be reduced by the same percentage. So the first process you must do is select a reference period, which can either be the period from February 15, 2019 through June 30, 2019, or January 1, 2020 through February 29, 2020. If the FTEs during your covered period are less, then your loan forgiveness will be reduced by a similar percentage. So for example, if you had 10 FTEs during whichever reference period you picked, and you had 8 FTEs during the covered period, you would have a 20% reduction in loan forgiveness. An FTE is defined as an employee who works 40 or more hours on average each week. So the hours of employees who work less than 40 hours are calculated as a proportion of FTEs. So for instance, if someone works 30 hours, they would be a 0.75 equivalent of an FTE. And also the guidance also gave the borrowers an opportunity to elect to treat FTEs as a half of FTE if you're under 40 hours. Pick all in any, so if you had 10 hours or 20 hours or 30 hours, everybody would count it as a half. And that was picked as an administrative convenience. So in other words, if you have 30 full-time employees and 10 less than full-time employees, you would count it as 35 FTEs under that calculation instead of going through calculating each employee. There's also salary reduction. So for each employee paid less than 100K on an annual basis, you must reduce the total forgiveness amount by the total amount of salary reductions that are in excess of 25%. So reduction is done on a per employee basis. The other thing that was kind of new or kind of clarified was that borrowers wouldn't be doubly penalized for the salary reduction, as it applies only to the portion of decline in wages that is not attributable to the FTE reductions. And there's some safe harbors under the FTE reductions. For instance, if you restore the employees to the exact amount of your FTEs by June 30th, 2020, you'll not have any reduction. If an employee is terminated for cause, voluntarily resigns, or voluntarily requests a reduced schedule during the covered period, you won't have to count that as an FTE reduction. And if you previously laid off an employee or reduced their hours and then offered to rehire for them for the same salary and same number of hours, and an employee declines, it won't count as an FTE reduction. And but what you need to do is you need to make a written offer, document the rejection, and then inform the state unemployment office within 30 days of what occurred. Under the alternative covered period, so the other thing that was created recently was that originally it's the act said that payroll costs would have to be paid and incurred during the 8-week period that would be eligible for forgiveness, and then that would start on the date you received your PPP loan. So what this clarified is that payroll costs are paid or incurred during the 8-week period are eligible for forgiveness, and also allowed that you can pick an alternative covered period, which because the 8-week covered period will not always align with your payroll cycle. So for administrative convenience, a borrower with a biweekly or more frequent payroll may elect to use an alternative payroll covered period that begins on the first day of the first payroll cycle in the covered period and continues for the next 8 weeks. The other thing that was kind of clarified that I think Mark brought up a little bit is they also stated that bonuses and hazard pay would count as compensation as long as it did not exceed the $100,000 cap. And another item that was clarified was that owners and employees and self-employed individuals are capped by 100,000, as we knew before, or 852, which would be 8 weeks of their 2019 compensation if it was under 100,000. So in other words, if an owner was paid 80,000, you can't increase their compensation to be 100,000 and get forgiveness on that. So that's kind of the first 3 bullets. I'll turn it over to Taylor to talk about the next 3.
Yeah, thanks, Drew. Good afternoon, everyone. This is Taylor Shea, and I'll be covering the last 3 bullet points that we have identified on our PowerPoint in front of you all. So the next topic we'd like to cover is the new guidance we've received with respect to costs that are eligible for forgiveness. And the first category here that I'll discuss is with respect to bonus payments, hazard pay, and payments to furloughed employees. Mark and Drew touched upon this a bit earlier, but to elaborate a little more, the new interim final rule that was issued last Friday clarified that all of these payments, that would be the bonus payments, hazard pay, and payments to furloughed employees, all of those payments are eligible for forgiveness so long as they were paid during the covered period and so long as the payments made to each employee do not exceed the prorated annual salary cap of $100,000 per employee, as was mentioned earlier. So to summarize, those payments, bonus payments, hazard pay, and payments to furloughed employees all remain subject to that 100,000 salary cap, but are otherwise payroll costs that are eligible for forgiveness as long as they're paid during the applicable covered period. In addition, the new guidance offers clarification on whether costs need to be paid and/or incurred during the applicable covered period. So to give you all a quick background here, the initial PPP guidance indicated that payroll and non-payroll costs eligible for forgiveness needed to be both paid and incurred during the covered period. However, the forgiveness application, which was released on May 15th, 2020, instructed borrowers to enter eligible costs incurred or paid during the covered period, or the alternative payroll covered period if applicable. So the phrasing of the application combined with the initial guidance sort of left many wondering, was it truly an or, meaning, a cost could be forgiven if it was either paid or incurred during the covered period, or did it mean something else, such as that the cost still needed to be incurred during the applicable covered period, but could, under certain circumstances be paid outside that covered period. So in any event, the uncertainty left from the forgiveness application was resolved in the interim final rule that was issued last Friday. The rule indicates that payroll and non-payroll costs will be eligible for loan forgiveness if they are incurred or paid during the covered period. So to reiterate, the new rule states that any costs, whether they are payroll or non-payroll costs, are eligible for forgiveness if they are either 1, paid during the covered period, or 2, incurred during the covered period. So long as they are paid on or before their first applicable due date immediately following the end of the covered period. So that would mean on or before the next regular payroll date for payroll costs, or on or before the next regular billing date for non-payroll costs. So, perhaps, the clearest guidance that we've received on this point to date is by way of the examples that are in the interim final rule that was issued last Friday. And specifically, they gave an example where if a borrower's covered period begins on June 1 and ends on, June 26, if that borrower pays its May and June electricity bill during the covered period, both the May and the June bills are forgivable because both were paid during the covered period. So in this particular example, it doesn't matter that the May bill covered an expense that was incurred prior to the covered period. It's still forgivable because it was paid during that June 1 to July 26 covered period. And then in addition, if there was a July bill, but that would be forgivable as well, so long as it's prorated through July 26, which would be the end of the covered period in this example. So that July bill prorated to only July 26 is also eligible for forgiveness because it was incurred during the covered period and then paid on the next regular billing date, even though the next regular billing date was technically after the expiration of the covered period. So this is all important clarification for borrowers pretty much across the board. So again, it's very clear by this example that the costs are eligible for forgiveness if they are paid during the applicable period or incurred during the applicable covered period. With the one caveat, obviously, that the costs that are incurred must be paid on or before the next scheduled payroll or billing date. So I guess 2 quick final points on this before turning to the next topic. The first would be that both payroll costs and non-payroll costs, in both of those instances, borrowers cannot double count expenses. So if they are both paid and incurred during a covered period, that can only be counted once. You can't double count. And then the second point would be to point out that the new guidance says that advance payments of interest on a covered mortgage obligation are not eligible for forgiveness. Those would be considered prepayments and are specifically excluded from forgiveness. So now to turn to the next bullet point, this would be the safe harbors and the reduction exceptions. We've heard a little bit about this from Drew earlier, but for this topic, I'm going to cover the safe harbors and exceptions with respect to forgiveness reductions. And so, a borrower's forgiveness amount may be reduced if the borrower reduces its employee headcount or wages in excess of 25%, as Drew mentioned. But notwithstanding these potential forgiveness reductions, the new interim rule issued on Friday reiterates the June 30th, 2020 safe harbor that we previously knew about. Specifically, if a borrower reduces its full-time equivalent employee numbers or reduces wages by more than 25% between February 15, 2020 and April 26, 2020, then that borrower has a safe harbor and will be exempt from any reduction in loan forgiveness if they return the full-time equivalent employee numbers or restore the wages as applicable by June 30th, 2020. And in addition, the new guidance states that a borrower's forgiveness amount will not be reduced for employee headcount reductions if the borrower made a good faith written offer to rehire the employee during the covered period or the alternative payroll covered period as applicable, if the employee rejected the offer. And this is consistent with the SBA FAQ question number 40 that was previously issued. But in addition, what we've also learned is that forgiveness will not be reduced with respect to any employees who during the covered period, again, or the alternative payroll covered period as applicable, were terminated for cause, or who voluntarily resigned, or who voluntarily requested and received a reduction of their hours. So again, we know that the June 30th, 2020 restoration safe harbors continue to apply with respect to headcounts and wage amounts. And now we also know that borrowers will not be penalized for terminating an employee for cause or voluntary resignation or reduction in hours, or if the borrower attempted to rehire the employee and the offer was rejected. So now the last point here that we'd like to touch upon quickly is audits. And so I'll touch upon some of the changes that have developed since our last webinar regarding PPP loan audits. The forgiveness application, which again was released on May 15th, requires a borrower to specifically disclose if it, together with its affiliates, received a PPP loan in excess of $2 million. This disclosure appears to be in line with the developing guidance regarding audits of PPP loans. And, so by way of a quick background here, on April 29th, the SBA announced in FAQ number 39 that all PPP loans in excess of $2 million would be subject to an automatic audit. Subsequently, and really in response to the great uncertainty regarding how to properly interpret and apply the necessity certification in the PPP loan application, the SBA issued FAQ number 46 just 2 days before the loan forgiveness application was released. And this FAQ stated that any borrower who, together with its affiliates, received a PPP loan in an amount of less than $2 million would be deemed to have made the required need certification in good faith. So, the rationale given for this apparent safe harbor was that borrowers with loans below this amount are generally less likely to have access to the adequate sources of liquidity in the current, economic environment than borrowers who obtained larger PPP loans. Obviously, that is not always the case, and there have been quite a bit of commentary regarding this arguably arbitrary threshold. But for now, it seems that there is a safe harbor, at least with respect to an audit based on the necessity certification alone. Of course, an audit or other government oversight may still occur for other purposes, and based on other factors. And in fact, in a second interim final rule that was issued last Friday, the SBA made clear that it may review any PPP loan they deem appropriate, regardless of the applicable loan amount. So, however, in this rule, the SBA also addressed for the first time the fact that borrowers will have an opportunity to respond to inquiries regarding a review of their loan and their forgiveness request. And they will have the opportunity to appeal a determination by the SBA that the borrower is ineligible for PPP loan or for loan forgiveness. We're told that a separate interim final rule will be issued to address this appeal process, but for now, there's at least a bit of comfort for borrowers that there will at least be an opportunity to respond and advocate for yourself in the event your forgiveness is denied in whole or in part. So, I think that wraps up our quick overview of the new PPP guidance with respect to forgiveness. And the forgiveness guidance available to date provides borrowers with important clarifications on the topics we've discussed, but there are still many important questions that remain unanswered. So, with that, we'll turn to two of the open issues that are getting a lot of attention in Washington and really throughout the country. Greg discussed them a bit earlier with regard to the bills that are pending, but I'll turn it over to Drew to discuss the potential expansion of the covered period.
Thanks, Taylor. There's actually two bills out there, one in the Senate and one in the House, to expand the covered period, and one it states it goes to 16 weeks versus 8, and one says it goes to 24 weeks. So what I would interpret that to mean is something is going to happen, whether it's 16, 24, they split the difference and go to 20. But what I've also seen in practice when we started advising our clients on how to look at their forgiveness and more or less try to determine how much forgiveness they would receive, it's very difficult under the present rules, even when people bring our employees back and are fully employed, to be able to get the total forgiveness. So, which is the goal of most of the people that have received the PPP loan. So I think with expanding it to 8 or to 16 or 24 weeks, it would allow more the borrowers to receive full forgiveness. It definitely would allow more to receive, get it closer to full forgiveness and not have that loan, that 1% loan to be paid back over 2 years. So Taylor, I turn it back to you for the next issue.
Yeah, thanks, Drew. So, in addition to the potential expansion of the covered period that Drew just discussed, another element that's received, considerable amount of attention is the requirement that 75% of the loan forgiveness amount needs to be attributable to payroll costs as opposed to non-payroll costs. So non-payroll costs can only make up 25%. Many commenters have focused on this requirement and urged the government to revisit it. Some critics of this 75% rule have argued that it doesn't do enough to accommodate businesses whose employees haven't been able to work because of the government-imposed business closures. And the 75-25 forgiveness rule is not in the CARES Act itself, although it was set forth in the very first interim final rule that was issued and has subsequently been reiterated, including in an interim final rule that was just issued on Friday. But in any event, as Drew's mentioned and Greg and Mark earlier, there are bills floating around, and in any event, we need to stay tuned because the legislature is considering relaxing this rule. What it might look like, we don't know. It could mean that the law evolves to recognize that some borrowers will not be able to get to the 75% mark for payroll costs, as sort of Drew alluded to earlier. Or it could mean that they allow borrowers to use more money for non-payroll costs. The bottom line here, though, is that we don't know whether the rule will be relaxed in the first place, and if it is relaxed, what that will look like. But we do know at this point to keep it on our radar, since it continues to be discussed, in Washington and elsewhere, as the PPP continues to evolve. And obviously we'll be looking for additional guidance on the PPP again as it continues to evolve, sort of across the board. But these two open issues are ones that we're already beginning to see traction. And again, we're seeing discussions in the legislature. And so it's ones that we wanted to make sure we're on everybody's radar at this point, especially because if either of these two take effect, they could end up having, a significant impact on the rest of the forgiveness calculations. And so everybody needs to be mindful of those.
Okay, Taylor and Drew, thank you. That was very informative. For the final segment of this webinar, we're going to open it up the conversation to Q&A. We received a bunch of questions from listeners, so I'm going to just sort of fire through the list and let this be a lightning round. And Drew, Taylor, and Mark, any of you can answer these questions. First question from our audience: please clarify whether PPP funds spent on something other than the four permissible purposes, payroll, mortgage interest, rent, lease, and utilities, will be treated. If someone uses funds to pay accounts payable, does this become a loan or is it considered bank fraud? Taylor, any thoughts on that?
Sorry if I was on mute there. So, the statute gives very specific permitted, eligible uses for forgiveness. But one thing to note is that the eligible uses that will qualify for forgiveness, there are additional allowable expenses in the statute. So there are other uses of the funds that are permitted, but that would not fall within the eligible category. So it would depend, I guess on where the payments fell within that. But so long as they are permissible under the laws that are out there for 7A loans to begin with, then they should be okay. But again, they wouldn't be eligible for forgiveness, and there's a little bit of gray area in there as to how the funds are to be used, because bear in mind, there's also certifications in the process that you're going to be using the funds for these eligible purposes, right? So I think it's a really great question, but we don't have firm guidance sort of either way, would be my take on that.
Next question, please clarify what qualifies as mortgage interest, lease payments, or rent payments on personal property. Will the forgivable loan cover equipment financing payments? Drew, any thoughts on that one?
I would say yes, as long as if it's a lease, equipment lease, it would be covered. If it's a mortgage attached to a piece of equipment, it has a UCC filing, it would be covered.
Okay. What is the definition and scope of transportation under utilities?
I think it's a good question. I don't think we know the answer to that one.
I would agree with that. We're struggling to figure it out.
Okay. Are there any specific or unique rules related to forgiveness for nonprofits?
No, not that I'm aware of.
I would think
I'm aware of
the only thing I would say is if you're a grant-funded non-for-profit, you may have some issues if you receive federal or state grant monies to cover payroll and are trying to also get forgiveness on that payroll. It would be a double dipping concept. So I think one of them you have to give in to one of them.
Okay. Mark, question for you. Our PPP proceeds were significantly less than what we applied for because of an error. Do we have a remedy?
So proceeds is what, are they talking about what they received? Or
what they received, it was different than what they had applied for.
Yeah, that was a calculation that was probably done by the lender, and I'm not sure. We've seen a couple of those, and there really can be no adjustment on, well, Friday would be the last day for adjustment. We have seen a couple of adjustments, but it has to be done before they filed their 1502s and 1502s, which is a reporting system by which lenders report loans to SBA. That's going to be done on Friday, and no adjustments can be made after Friday.
Okay, thanks for that clarification.
Taylor, I would just pipe in. Obviously, Mark knows how this is working administratively much better than we do, but I don't think we have clear guidance as to if there was an error in the calculation. But I would say that for those of you that are out there, if you applied and there was a change in the guidance after you applied, specifically there was guidance that came out with regard to including general partners in calculations. The guidance did allow an adjustment in that particular instance, but that again is a sort of a specific instance and doesn't necessarily address this, an error in the calculations, but did want to just raise that.
There was also a significant adjustment as it related to hospitality industry, where they could, if they had chosen one particular covered period, that they could go back in and readjust, particularly coming into a high season. And many of them did, and there are a couple of instances where I know where an individual business went from 300,000 to 900,000, but that's based upon certain criteria, and there again they were allowed to do that, but they had to do that prior to the 1502 being submitted to the agency, which will be on Friday.
Okay, thank you. I am the sole employee at a company owned by myself and my wife. I don't do payroll. How do I provide evidence for forgiveness?
Well, we have continually recommended to people that if you did get PPP, that you put it in a separate account, and that if you are a sole proprietor, you should be paying yourself on a weekly basis to have established evidence that you're paying yourself payroll based upon what you submitted. And my colleagues can agree.
I would, if you're a Schedule C filer, I would say that you would have to, you'd be capped by the amount of compensation calculated based on your 2019 net profit. Mm-hmm. So that would be off your 1040 return.
Yep, I agree with that.
Okay. Is it advisable to hire a 1099 vendor as an employee to maximize forgiveness?
No.
Yeah, if he or she is an independent contractor, it doesn't count.
Right.
Now, and you have to be careful with that, because you have to, when looking at the statute itself, it says that 1099s are eligible in their own right. And if you go through the interim final rule, it's very clear that if you have a 1099 on your payroll, you cannot count them for the purposes of PPP. To go back and to try to do that through the back door I think would be a difficult to justify.
Mhm.
Yep.
Can a company's funding of an HRA be considered medical expenses under the PPP?
I believe it is.
Yeah, I think the answer is
Yep.
yes.
Yes.
Okay. Our building lease agreement has costs defined as additional rent, such as common area maintenance charges. Will this qualify as rent?
I
I
believe
believe
it.
so.
Yeah.
And next, Mark, I think you mentioned this, but one of the listeners asks, should we set up a separate bank account for PPP loan funds? You suggested yes.
Yeah, I from day one, I've been saying that only because it makes it cleaner for the individual business. And I know that many of the lenders have required the small business people, even if they have current accounts within that particular institution, to set up a separate account just for PPP. And it's just from an accounting standpoint, so that you'll know where the money is going, and that there won't be any question at the end of the road.
We've similarly been advising clients to do the same across the board if possible.
Does an LLC partnership need to present different materials to document forgiveness than other types of companies?
I don't understand the question, to be very frank with you.
If you're a general partner in an LLC, I would think you would you'd have to show your net earnings from self-employment on your K-1.
Okay. What can be creatively included in rent, utilities, etc.? Does the 75% payroll retention apply to each employee individually?
75% applies to each employee individually. Creative in what? Rent?
Yeah. What can be done? What can be creatively included in rent, utilities, etc.?
Well, we shouldn't be talking about creativity in front of the SBA.
That's okay, we're recording this.
I think it's pretty specific. So I think it's very difficult to get around some of those things. I would say utilities are very specific, except for transportation, which I guess we could interpret. I don't know if you could interpret that as different things like reimbursement of mileage for people that are traveling that you might reimburse. I would think that.
Well, I actually I would take it one step further, to be very candid with you, Drew. I think transportation can also be. There are a number of companies, construction companies, or just general transportation companies that have to purchase gas.
Yep.
And I mean, just from the reading that I have, I think that that's all included in there as well.
Yep, I would agree.
Maintenance on vehicles, if it's a portion of what that business is all about. And I think, and I'm not saying that people should be creative, but they should be honest. There are certain, if you're a, just based upon, or you have people working remotely, I don't think that transportation costs are going to come in quite as heavily as other things, but.
Okay. Will the relief program be changed, allowing use of PPP loans to buy personal protective equipment for upgrades like sneeze guards to reopen offices?
That's part of the legislation, I believe, that's currently under. I think that was Senator Rubio had included that in on his bill. I don't think right now you can do that, but it's all dependent upon what happens with any additional legislation.
Yeah,
Exactly. Yeah.
What if I have leftover funds?
It's a 1% loan paid over 2
Turn them
years.
back.
Okay.
Yeah, this question has come up quite a bit, as to what companies can do. Obviously, if a portion of it is not forgivable, then that converts to a loan. But there have been discussions about, should people be paying it back to the extent that it, exceeds the eligible uses, if you will. I think some part of that is an open question, but I think certainly we know that if a portion of it is not forgivable, then it would convert to a loan.
And I think this question's been addressed, but I'm going to ask it again. Can you provide some clarity on the payroll periods that should be used in the PPP loan forgiveness calculation?
I think Drew probably covered that during his discussion as well. But that's, or maybe Taylor. I'm not sure, but it really is dependent upon. You do not have to start it on the very day. If your payroll is run on a biweekly basis, then you can start it on the next biweekly basis payroll, and then run 8 weeks from that point.
Exactly.
Yep.
Mark, this is a question for you. When will the names of recipients, PPP loan recipients, be named and released to the public?
I would suggest you FOIA them.
Okay.
If you ask me, did XYZ Corporation get it? I can go in the system and find that.
Yep.
But they stopped updating our EIS system on April the 9th, so I can't see what's happened post April 9th.
Okay. We're actually rounding up the last of the questions from the audience. I did have a sort of a question for each of you as we sort of wrap this up. I was wondering what happens, after the PPP funds start to run out. What do you anticipate businesses doing? Once their 8-week period is up, they've used their funds, they're getting the forgiveness. What's next in terms of how they should be thinking about operating their business once that safety net is no longer there? Drew, do you want to just start on that? What your thoughts are?
I think every business should be in a planning mode right now, looking out the next few months, 3 to 6 months, doing cash flow projections, revenue projections, and cost containment projections if they feel like their business is not going to get back to normal, which probably it isn't. There's a lot of unknowns out there. Basically, what is going to happen and where's it going to be in a few months, but I think we have some encouragement that as things start opening up but until we get some more activity, I think businesses are going to have to look at their operations in their particular business. We have clients that are doing really well in certain businesses and others that are doing extremely poorly or having difficulties. So I think it's an individual basis, and I would advise that they get really tight on controlling. I advise people to actually look at it in small increments, like weekly, where you are based off some projections or forecasts.
Yeah, I would echo that. I think that's great advice. I think companies all need to be looking at their own circumstances and doing their own independent analysis and planning purposes. Obviously, the law here, one thing we know for sure is that it's evolving continually, and so stay apprised of the changes and the updates, because it's a real time laws that are evolving. And so to the extent that any new developments arise or any existing guidance changes or new options become available, I would just say, keep planning, keep using, prudent business judgment, but also stay advised of all of these evolving laws regarding various relief programs.
Mark, question for you. Has there been any talks of maybe allowing businesses to go for a second round of PPP funding if money remains, or has that not been talked about?
You're outside my wheelhouse.
Sure. Okay.
But I do want to kind of weigh in on the last question, and that is, listen, SBA has tremendous resource partners with the Small Business Development Center, which is headquartered out of the University of Connecticut, UConn, with our 2 women's business centers, Fran Pastore, who has 2 offices, and then there's she has one in New London, and there's one in Stamford, and then we have also a 3rd women's business center up in Hartford, and as well as our SCORE volunteers, which are, they're retired business executives. And my recommendation to people is, they're all free resources. Utilize those free resources to help you guide you through these next a few weeks or months. I mean, they're really there. They're there for you to help you. I always say that businesses don't plan to fail, they fail to plan. And I think here's a great opportunity for people to utilize experts at no charge to try to get you through this. And where we're going from here, is there going to be additional, resources? I don't think anybody knows right now, but clearly in certain sectors of the economy, there are going to be challenges just based upon the capacity and allowing capacity to be in hospitality. Let's be very candid. Hospitality is a huge issue here. So if we could get hospitality back up and running, I think that is going to be a major challenge. Manufacturing will have a different challenge as long as they can social distance. And I think if they can, then they can go back in and they could probably have less of an impact than others. But that's just my own opinion. But utilize the 3 resources we have.
Thanks, Mark. I'd like to wrap up today's session by thanking all of our speakers for joining us, as well as our sponsors for supporting this webinar. For listeners who are looking for more information, please check our websites, hartfordbusiness.com and newhavenbiz.com, for continuing coverage of the PPP program, as well as the coronavirus's impact on the Connecticut economy. Also on our websites, under the Events tab, if you click on Webinars, you'll soon find a recording of today's session, as well as numerous resources for businesses that want more details about the PPP program, as well as other programs that provide support for small businesses. Thank you for joining us today, and be on the lookout for more HBJ webinars in the weeks ahead. Thank you, Drew, Taylor, and Mark.
Thank you.
Take care.
Thank you. Have a good day.